Finance. It's a word that sounds complicated, but at its core, finance is simply the management of money. Whether you're a student, an employee, a business owner, or a billionaire, finance affects almost every decision you make. In the next 5 minutes, I'll explain the basics of finance as simply as possible. Let's get started. Finance is all about three things: earning money, managing money, and growing money. Think of money like water flowing through a system. Money comes in through income. It flows out through spending. And whatever is left can be saved or invested. The goal of good financial management is to make sure more money comes in than goes out and to put the extra money to work. Everything starts with income. Income is money you earn from a job, a business, investments, or other sources. Next come expenses. These are things you spend money on, such as rent, food, transport, subscriptions, and entertainment. The difference between your income and expenses is called savings. For example, if you earn £2,000 a month and spend £1,700, you save £300. Many people try to save what's left over at the end of the month. Successful savers often do the opposite. They save first and spend what's left. One of the most important concepts in finance is understanding the difference between assets and liabilities. An asset is something that puts money into your pocket or increases in value over time. Examples include investments, rental properties, businesses, stocks, and index funds. A liability is something that takes money out of your pocket. Examples include debt, credit card balances, and expensive loans. The wealthy tend to focus on acquiring assets that generate income or appreciate in value. The more assets you own, the easier it becomes to build wealth. Saving money is important. But investing is what helps your money grow. When you invest, you're using your money to buy assets that can increase in value over time. For example, if you invest in a broad stock market index fund, you're buying small pieces of many companies. As those companies grow, your investment may grow too. Investing involves risk. Prices go up and down. But historically, long-term investing has been one of the most effective ways to build wealth. The key is consistency and patience. Now let's talk about compounding. Compounding is when your money earns returns, and then those returns start earning returns too. Imagine you invest £1,000. If it grows by 10%, you now have £1,100. The following year, you're earning returns on £1,100, not just the original £1,000. Over time, this effect can become incredibly powerful. That's why starting early often matters more than investing large amounts later. Not all debt is equal. Bad debt is typically used to buy things that lose value and don't generate income. Examples include high-interest credit card debt or financing expensive consumer goods. Good debt is sometimes used to acquire assets that can generate income or increase in value. For example, a business loan used to expand a profitable business. The key question is simple: is the debt helping you build wealth, or is it reducing your future financial freedom? So, finance can be summed up in one sentence: earn money, spend less than you earn, invest the difference, and give it time to grow. That's the foundation of personal finance. Master those basics, and you already know more than most people about money. If you found this helpful, subscribe for more simple finance and investing content.